In today's video, I am going to be breaking down essentially a good way that you could invest your first $10,000. The best way is to actually just stay as safe as possible. Now, before you start saying, well, wait a second, can make all this money with Bitcoin, that's true. You could. You could also lose a lot of money with Bitcoin. So, usually when you're basically investing your first $10,000, you generally can't lose that money. What I mean is, let's say it's your first $10,000 and I was there once. You want to go safe mainly because, I'm going to give you my example. I invested in Facebook. That was literally the first stock I invested in, and I invested in on IPO day. Yeah, I bought it at $42 a share and it dipped all the way down below $20. I held on to it during that time. I couldn't lose my money. I couldn't. I didn't want to lose my money. But I believed in the company. However, if I lost my job, if I lost my company, because I ran both, I did both at that time. At that point in time, I was doing both. I was running my business and I was working a job. However, if I lost both or one or the other, I would have had to sell those shares because I needed that money. And if I sold those shares, guess what? I would have been down huge. And it was inside of a TFSA. Which means that I would have lost a lot of my contribution room because I would have sold at a loss. So because of that, I always suggest going as safe as possible because you never know when you're going to need that money. Oh, and by the way, I ended up selling those shares of Facebook at just over $100 a share total. I did buy a few more every time it went lower. I sold some at just over $80 a share, and then I sold the rest of them when they just went just over $100 a share. And if I still held on to them today, they'd be worth even more money. But I used that money for other things, which was other investments that were much safer than Facebook at that time. So the first ETF I would actually suggest, and I would suggest ETFs, not individual stocks with your first $10,000, again to limit risk. And that is XIC. This is an ETF that has massive volume at 500,000 shares traded every single day, which means that it's very easy to get in and out of. For example, if you had an ETF that was only having an average volume of 1,000 shares and you wanted to buy 4,000 shares, well, guess what? You would probably be waiting all day to get that transaction cleared because there's just not enough volume to get those shares cleared, which means that if you're investing in something that has a high volume, you can get in and out of it super easily, again to limit risk. Next is yield. That's your dividend. By owning stocks, and some stocks, they will pay you out of their earnings as a thank you for investing with them. Guess what? Because this is an ETF that invests in multiple different companies, an average yield for all the companies that it holds is 2.5%, which means that if you were to invest $100, you would generally get $2.52 a year, with this one divided by 4 quarters. So, of course, that's pretty good, and if you can reinvest that money, I personally reinvest my money in other ETFs and other stocks. However, if you're just starting off with maybe a couple of $100, then you would generally want to just reinvest that in the same ETF, and you can set that up with your brokerage. And the MER, which is how much it costs to buy an ETF or to hold an ETF, is 0.0% per year, which means that if you have $100 in there, it's going to cost you about 6 cents per year. Now, if that price doubles to 200, then you would be basically paying them 12 cents at that time to essentially invest for you. This is why I say to invest in ETFs and not mutual funds. Mutual funds is what a bank would try to, of course, entice you to buy, because when you're investing in an ETF, you're basically getting the same type of investment for less money. Here it's 0.06%, and the average mutual fund is somewhere between 1.5% and 3% per year. So you're basically, if you're looking at the cheap end, which is generally 1%, instead of giving away $1, you're only giving away 6 cents. per $100. So that's a massive, massive difference, especially when you start putting in, let's say, $10,000. 1% of $10,000 is $100. So $100 instead of maybe $6 is a lot more money. So keep that in mind. It has, again, steady growth. Yes, there are times where it goes down. Yes, there was this that happened, and lots of people panicked and sold down here and bought back up here, lost a lot of money. And usually when you're investing in the entire TSX capped composite, guess what? Cap just means that it's limiting how much it'll hold per company. You're basically betting on your country to continue to do well into the future. And you do get dividends every single quarter, and they generally fluctuate kind of throughout the year. You can also see on their website their entire holdings, but on Yahoo you can see their top 10 companies. And the top 10 companies on this one is going to be generally the top 10 companies in Canada, and that is by size. So Shopify is, of course, one of the biggest companies in Canada. Royal Bank usually battles them out for the top spot, and then TD follows up. TD is growing massively as well. These are all just fantastic companies. Enbridge is not just an oil company either. They are also investing heavily when it comes to green technology, green like stuff like solar panels, green energy, solar panels, wind farms, things like that. So they are looking into the future as well. There's also an option for something like a QQQ or a VGT in this case, where I chose VGT because it's cheaper than QQQ. And basically this is just a tech ETF. It's all the tech stocks. QQQ would be in the NASDAQ. This is basically the same thing. And you're essentially looking at covering the entire tech side of the market, and tech generally has higher chances of growth. However, this is the one I chose over QQQ, mainly because of the MER. The MER of this one is 0.1% versus a QQQ that is much higher. It also has really good volume of 800,000 shares traded per day. You're not buying this for the yield, but you do get 0.6%, which is still better than interest. This is why you would buy into a tech ETF. It's just massive growth. Imagine if you were to buy it here, just the massive growth since then. The only thing you have to keep in mind, however, is the fact that it has broken below its level of support, which means that we don't know exactly how far it's going to go down. It's just broke below this level of support there, and it looks like it's going to continue to go maybe down potentially a little bit farther. It's hard to really say. News is crazy at this point in time. There's a potential war. There's still COVID going on. So because of that, investing in tech is kind of risky. However, there is still high growth to be made. So how you would play that one or this ETF VGT is essentially just to basically buy the dips, but also buy a little bit at a time when it's going down. Something like this, it's always hard to tell when it's going to turn around. We've seen these drops before, and you can take guesses on, oh, this has got level of support here. Let's see if it breaks below. You can always try to time the bottom, but that just never generally happens. So always, if it's going down and it's something that you want to buy a little bit at a time until it gets to the bottom. That's what I was doing with CIBC when it was going down during the pandemic. I bought some at $90 a share. It dipped down to $85. I bought more per share. I got it near the bottom. I think I was like $1 off the bottom. I got the rest of my shares that I wanted to buy, and then I obviously made more money, and I was like, well, it's at like $90 a share. It's come back a little bit. I'm still going to buy in. And I was doing that with all the banks, really, not just CIBC. I just remembered CIBC's numbers off the top of my head. But VGT, again, gives you a nice dividend as well. And again, this is going to be actually quarterly, which is nice. QQQ, if I remember correctly, is once a year. Again, the top 10 tech companies generally in the United States, Apple is in the top. The only issue I have with this ETF is that Tesla is not in the top 10, and I think Tesla is going to be a massive growth story over the next 10 years. This is kind of a Canadian option to QQQ. The last VGT is not an exact copy of QQQ, however, ZQQ essentially is. And what you're getting here, again, is going to be much higher yield. This is remember, a Canadian ETF. However, if you're Canadian, this is fantastic. And Average volume of 130,000 shares per day traded. Fantastic. Dividend is 0.36, so not as high. Again, same idea. You're still seeing that break below that support line. So because of that, it is something to really watch out for. I really don't think it's going to be going up until this reaches below at least a little under $100, and that's at least a big level of support in my opinion. There's still another level of support a bit higher too, so there is a few ways it could bounce off. This one does pay once a year as well. This one is exactly a carbon copy, in my opinion, to QQQ. And from there, you are getting Tesla, which is the company that I have ridiculous amount of faith in, especially Elon Musk. He is definitely one of my favorite CEOs in the entire world ever. Actually, he is my favorite CEO of the entire world. VOO is a great option. It's the same idea as SPY. This is the Vanguard S&P 500. This is the top 500 companies in the United States. SPY is the exact same thing, except VOO gives you a lower MER. And, of course, ridiculous volume. We're looking at 7 million shares traded every single day. It's fantastic. 1.3% yield as well. Huge growth. Yes, this also has broken below that support level, or at least the trend line. However, it's getting close to that support level there, which is actually quite interesting. I didn't notice that until now. So that could potentially mean that there could be a turnaround, but it looks like it potentially could have dipped below. So there could be a little bit more downturn coming up. It's hard to say, but this is a fantastic time to buy ETFs because of the dip that just happened. This could be also technically, to some people, they may say that's a double bottom, but yeah, I'm not saying that. I'm not saying that at all. Dividend is quite strong. It has raised its dividend year over year, which is fantastic. That's what we want to see. Top companies in the United States, literally, I'm not going to go over those again. I've done this a million times in this video as well as others. This is kind of the Canadian version of the same thing. ZSP, 1.3% yield, and on top of it all, pretty good volume. However, the MER is a bit higher. You'll find that with any Canadian ETF that mirrors the American market, our MERs are a bit higher than the American MERs. However, I would suggest buying the Canadian ETF, mainly because then you don't have to deal with the international taxes and American withholding taxes and things like that. Now, you generally don't have to worry about that yourself. That would be all done by your brokerage. However, it's so much easier just to deal with Canadian ETFs. This looks like a stronger support here, so again, same idea. Like we're looking really strong. You're going to get generally 8% a year here. This is going to outperform most active traders on the stock market anyways if you just buy and hold the ZSP. So you're getting 8% a year plus a dividend of 1.3%. It's not too bad. You're getting, again, a growing dividend. From 2018, it went from 18 cents a share to 22, and then 22 cents again, and then 20. Again, we have to remember that we're still in a pandemic, so this is going to be pretty well frozen where it is for a bit, but they always do raise their dividend. And again, top companies, Tesla. Anyways, that would be how I would invest right now my first $10,000 on the stock market. It is something that is going to be safe. You don't necessarily have to worry about 50% drop on your money. Now, of course, that has happened in the past. It's not guaranteed that that's going to happen again, but it's also not guaranteed that it won't happen again. So overall, when you're investing in broad market ETFs, you are basically betting on the whole entire country, North America in general, the world to continue its growth, which it has over the last 150 years, but really ever. The world's always continued to grow. We haven't gone back to the Stone Age. So because of that, it's a good bet. Anyways, I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.